All right, let's talk about General Mills. On the surface, their latest earnings report looked pretty good. They beat expectations. But then you look at the stock, and it kind of just fell. So what's the deal? What did Wall Street see that maybe the rest of us missed? That's what we're going to unpack today.
Here's how we're going to break it all down. We'll start with the headline numbers. Then we'll really get into the weeds of the quarter. After that, we'll look at management's game plan, the tough questions they got hit with, and we'll wrap it all up with our final call on the stock. So first up, the earnings snapshot. An earnings beat is supposed to be good news, right? Well, for General Mills this time around, the story was a whole lot more complicated than that. And here it is, the central puzzle in a nutshell. General Mills comes in with adjusted earnings of 86 cents a share. That's a solid 5-cent beat over what Wall Street was expecting. You'd think that would send the stock up, but nope, it finished the day down. So why? To figure that out, we have to ignore the headline and look at what's going on underneath.
Okay, let's pop the hood and deconstruct this quarter. Because to really understand that weird market reaction, you have to see how different parts of the business are pulling in completely opposite directions. It's really a story of divergence.
This table, this is what the market was really looking at. Yeah, they beat estimates, but look at the year-over-year numbers. Adjusted earnings per share down a staggering 20%. Organic revenue down 3%. And their gross margin got squeezed by 120 basis points. See, that's the real story here. Beating low expectations doesn't mean much when the fundamental business is shrinking. And if you dig into the different business segments, the picture gets even more stark. I mean, look at this. The company's core engine, its main business, North America retail, sales absolutely plummeted by 13%. That's a huge problem. Now, the pet and international businesses did great, both up 6%. But that strength just wasn't nearly enough to make up for the massive hole in their biggest segment. So, the big question is, how is management planning to fix this? Well, they're putting all their chips on a new strategy, one they're calling the Remarkable Experience Framework. It's their big bet to get sales volumes growing again. And CEO Jeff Harmening, he was crystal clear on the earnings call. He said they are laser-focused on one thing, getting back to profitable organic growth. He sounded pretty confident that their plan is starting to work, even if we can't quite see it in the headline numbers just yet. So what does this playbook actually involve? Well, it really boils down to 4 key moves. First, they're making their prices more competitive to give consumers better value. Second, they're pouring more money into innovation, new ideas, new products. Third, they're making sure people hear about that new stuff, like the launch of Cheerios protein. And finally, they're backing it all up with stronger, better advertising. They're basically trying to attack the problem from every angle. But here's the catch, and it's a big one. To pay for all of this, the lower prices, the innovation, the ads, profits are going to take a major hit this year. Management didn't shy away from it. They reaffirmed their guidance, which calls for profits to fall by 10 to 15%. They are literally telling the market, hey, this is a reset year. We're accepting some short-term pain for what we hope is long-term gain. As you can imagine, Wall Street heard that and had some questions. Analysts on the call really started probing this strategy, trying to find the weak spots and make sense of the disconnects in the numbers. This right here was probably the sharpest question of the entire call. Management was celebrating that they're gaining pound share, which just means they're selling more physical weight of their product in most of their biggest categories. So the question is, if that's true, why are the overall company sales volumes still going down? It doesn't seem to add up. And management's answer had 2 parts. First, they said that some of their heavy but low-priced products, things like flour and dessert mixes, were down. And because those weigh a lot but don't bring in a ton of money, it skewed the overall average. Second, they said there was a temporary shipment timing issue in their pet business that basically created a 4-point drag on the company's total results. The other big area of concern was the pet business. Yeah, the segment as a whole is growing, but their really premium brand, Blue Wilderness, has been struggling. So analysts wanted to know, what's the plan to fix it? And they came prepared with a multi-part answer. For Wilderness, they're going to refresh the brand with a focus on protein and new ads. Then, they're bringing in a new super premium brand from Europe called Egor and Cooper, just for PetSmart. And finally, they're going to lean into the parts of the pet business that are already doing really well, like their core Blue Life protection line and their cat food. All right, we've looked at the numbers, we've heard the strategy, we've listened to the concerns. Now let's put it all together and make our call on General Mills and the path forward. Looking ahead, if you're following this stock, here are the key things to watch. In the next quarter, we're watching the rollout of Blue Buffalo's fresh pet food. In the second half of the year, the big test is whether their price cuts finally get organic sales to turn positive. And all year long, you have to watch the macro stuff, how they handle inflation and how they fight against private label brands and even the effects of new weight loss drugs. So this all sets up a classic bull versus bear debate. The bulls are looking at those early share gains and saying, that's the green shoot. Volume growth is coming. They're betting the pet food innovation is a home run. But the bears are looking at that North America business and worrying it's just fundamentally broken and that this profit pressure is going to stick around for a lot longer than anyone thinks.
After weighing everything, our official call here at Talk Tickers on General Mills is market perform.
And here's the thinking behind that. On the one hand, you have to give them credit. They have a clear plan, and those pound share gains are an encouraging sign. But on the other hand, you just can't ignore that deep, double-digit decline in their most important business. That is a massive hole to climb out of. So with the company itself telling us that profits are going to be down big this year, it's really hard to see the stock outperforming. We're in wait-and-see mode. Which leaves us with the one big lingering question. Can this big reinvestment year actually work? Can it pivot this massive company back to growth? Or is this all just too little, too late, especially in a world where the consumer is so squeezed? The next few quarters are going to tell the whole story.
And of course, this is not financial advice.